Hello value investors, thank you for tuning in. In today's video we're going to talk about Stamps.com and whether there's any potential for shareholders. Now, it should be said that a few years ago I was quite bearish at Stamps.com, and as it happened it did come down its valuation significantly, and then I kind of felt okay, things are too pessimistic right now, and I reported that I believe that investors could make quite a substantial upside over time. Now, I had no expectation that it would rally as strong as it did. However, I did note that it was quite significantly shorted. So I should have put my money where my mouth was. I did not. I have no position. I've had no position either in Stamps.com, but it did rally significantly. Now you're in a position where the company has really managed to turn around the corner. Nevertheless, you got revenue growth rate this year of 5%, and maybe they reach 7% next year. So it's not so attractive as an investment presently compared to what it has been over the last 12 months. But anyway, without further ado, let's get started.
So as I said, Stampscom is a mixed bag investment. On the one hand, it used to be a very high growth company. On the other hand, it's going forward, it's not going to be as high growth. There are two problems here. The first one is that the share price leads one to believe that it's still going to be a high growth company, and it's not. Secondly, and more pertinent here, is that the way that it's been growing historically is by a strong merger and acquisition as a plan. So if assuming no more mergers and acquisitions, its organic growth is pretty stable. Now, you can contend that, as we've seen from the results, that in March it had a very strong customer acquisition pattern, and in April there was approximately 300% customer acquisition year over year. Some of those will stick around the platform, some of them will not as the economy opens up again. However, I just wanted to do as a sanity check to see what other analysts were saying. So I got this screenshot from Seeking Alpha's premium tools, and you can see very much that even at the top end, taking into consideration the possible bump up of the revenue from the shutdown period, is still coming in around 600 million, and even at this top end, the growth is only 5%, and looking out to next year, it's only 7%. So it's analysts that follow this company seem to believe, as I do, that its strong growth days are behind itself. Further complicating the story, if you look on the proxy statement, you can see that management have 1 million shares that they can options that they can exercise. Now, given that a large portion of these options are in the money, given the strong run up in the share price over the last 12 months, management will most likely dilute the shareholder by close to 5% as they fully execute all these shares. So on the one hand, you're not having that much growth, and on the other hand, management's going to be executing a large portion of their shares. Also, we must consider the fact that, as I said, yes, the middle of this range is 575 of revenue growth, and you kind of paying a large premium. Also, on a non-GAAP basis, remember, on a non-GAAP basis, it means that they're adding back the stock-based compensation, they're adding back their high taxes as well, and their amortization. They have a very significant amortization because they keep acquiring companies at a large premium and then having to amortize that later on. So even if you add all that back up and you take the highest number, which is $5, and you look at that compared to today's share price, you're paying approximately 38 times forward earnings on a non-GAAP basis for a company that is not going to be growing at 10% for the foreseeable future. That's a very large premium. Now, it's not the end of the world. there are worse investments to make, but I'm no longer feeling that this investment is worth investing in compared to what it was. I believe that most of the money has left now, and while momentum may carry this forward as investors continue to see the share price go up, no one's going to really be asking difficult questions. But at some point, people are going to start saying whether paying 38 times forward multiple on a non-GAAP basis for a company that's not growing particularly strongly makes for a rewarding investment.
So in summary, you have this case where management can dilute the shareholders, so you end up having a large dilution, kind of hitting around 5%, while at the same time on the top line of its guidance, you're kind of paying 38 times forward non-GAAP guidance. It's a punchy multiple for a company that is likely to be growing at less than 10% over the next couple of years. I believe that there are better opportunities available. Anyway, hope you enjoyed this video. Please subscribe, and I'll see you next time.